Let's jump right in. Welcome back to our ongoing explainer of the EURUSD strategic series. Today, we're taking a calm, documentary-style look at episode 11 of the GoldMining Europa data. And honestly, we're just letting the raw MetaTrader 5 numbers tell the story here. And the story this time? It's all about disciplined recovery after a period of temporary adversity.
So, as we look at the official metrics and the macroeconomic backdrop for the week, the overarching theme is crystal clear: strategic gains achieved through absolute discipline. We're going to break down the exact performance of this real cent account to see exactly how it navigated some pretty turbulent waters in the foreign exchange market.
Now, it's really crucial to remember exactly where we started this particular trading week. We began in total uncertainty, but ended in a perfectly disciplined recovery. If you remember from our last look, going into this week, there was an unresolved floating drawdown, just kind of hanging over the account. Open positions were in the red, which naturally creates a pretty tense environment right from the opening bell. The market was absolutely testing the system. Let's talk about the macroeconomic pressures that were building up. Throughout the week, the Euro-USD gradually rotated lower. And why? Well, the financial markets were hyper-focused on shifting Federal Reserve interest rate expectations, rising Treasury yields, a changing inflation outlook, and just a broader surge in overall U.S. dollar strength. These macro forces created intense, albeit temporary, downward pressure on the euro. But here's the thing. While this creates temporary adversity for open buy positions, it also creates the exact volatile environment the algorithm actually needs to execute its strategy. And you can see how this volatility had a real-time impact. That sharp, sudden downward plunge of the equity line right there, that represents a live stress test. It shows you exactly what it looks like when a mechanical system has to absorb a market shock before it can bounce back. Let's put a hard number on that pressure. This temporary mathematical adversity resulted in a maximum weekly drawdown of approximately 11.34%. Now, an almost 12% drop, that might cause a human trader to start sweating, maybe even close out out of fear. But surviving this dip is exactly what makes the algorithm's subsequent recovery so incredibly impressive. Even under all that pressure, mapping out the 15-minute trades reveals the exact entry and exit nodes during that downward rotation. Amidst all the market chaos and dropping prices, there was literally zero panic. The expert advisor just kept executing its predefined recovery logic. No manual intervention whatsoever, just cold, calculated execution as it built its strategic recovery basket right into the dip. Looking at the risk management side of things, it's actually pretty amazing. Despite that 11.34% equity drawdown, the deposit load, meaning the actual capital exposed to the market, remained incredibly modest the entire time. It never spiked to dangerous levels. And the second the recovery basket completes, that load instantly drops back down to almost zero. So here's the climactic moment. As the market finally provided that necessary upward retracement, the algorithm executed its exit logic flawlessly. A whole sequence of buys and sells closed out together in a single basket. This is the exact moment the tension breaks, when unrealized floating losses finally convert into hard, realized profit. That turnaround is marked by a sharp vertical spike in equity. The floating equity recovered almost completely in an instant, snapping aggressively upward to meet the balance line, which then stepped up to a brand new higher plateau. All that uncertainty that plagued the early week completely and mathematically resolved. To put a hard number on the success of that disciplined recovery, the actual weekly gain for the accounts came in at exactly positive $165.55. The storm was weathered and the profit was officially secured. And when we translate that cent value into our weekly growth metric, it represents a highly impressive gain of 6.24% for just a single week. I mean, that is a remarkable turnaround from an 11% drawdown just a few days prior. Breaking down that 165.55 total, seeing the gross profit effectively outpace the gross loss, it really reinforces a fundamental concept for us. Floating losses are really just temporary mathematical adversity, provided your system has a defined statistical edge and, most importantly, the discipline to let the math play out. So let's zoom out and see how this builds the bigger picture. We're comparing our isolated weekly victory of 165.55 to the total overarching profit of the account so far, which is currently sitting at 319.05. This is the perfect transition from focusing on a single, isolated weekly event to understanding the broader, long-term progression of the strategy. Looking at the overall balance in equity since inception, you can see the journey hasn't been just a perfectly smooth straight line. Notice those deep, volatile fluctuations in the equity curve over the months. But look at how this week's recovery fits right into a larger, ongoing pattern of resilience. Despite the wild market swings, the balance line just relentlessly stair-steps upward.
That relentless upward progression brings the total growth figure since inception to an impressive 12.76%. That single number, it represents the cumulative power of surviving macroeconomic volatility week after week and mechanically profiting from the subsequent market recoveries. Thanks to that growth, the new high watermark for the account balance now sits cleanly at $2,819.05.
As we look at these numbers, I want to remind everyone of the grounded reality of this case study. We are tracking a real cent account. It started with a very humble baseline of 2,500 cents, which is about 25 US dollars. It currently stands at 2,819.05 cents, and it is steadily, mechanically marching towards its ultimate objective of 10,000 cents. No massive leverage, no wild gambles, just slow, steady scaling.
So what's the big takeaway from all this data today? Well, the core lesson here is that long-term consistency comes from disciplined execution, not from trying to magically predict every chaotic market movement. The macroeconomic forces we discussed earlier, the Fed rates, the yields, the dollar strength, they're always going to cause turbulence. It's impossible to predict perfectly. But mathematical discipline, executed without human emotion, is exactly what reliably resolves that turbulence into consistent profit. We'll wrap up today by returning to the foundational philosophy that drives this entire explainer series. Real accounts, real risk, real progression. There are no exaggerated claims here, just raw MT5 data and verifiable trading history. And it leaves you with a slightly provocative question to ponder for your own financial journey. Are your strategies built on hype, guesswork, and emotion, or are they built on mechanical, unwavering discipline? Thanks so much for exploring this data with me today. Stay disciplined and keep learning.